Deep, 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 seek, deep, seek, deep, seek, deep, 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 deep. Hello, everybody. We have a negative narrative. So what? So what? So what? So what? Look, man, I'm tired. I'm tired. I've been telling everybody why the market was going to correct for 4 months. What did I say? Overvaluation plus what? Leads to a stock market correction in the short to intermediate term. Overvaluation and what? What's the other thing that causes a stock market correction? What is the number one correlated thing to market returns, to asset price returns? Number one correlated thing. Number one, above everything else, far and away, not even close. Is it politics? Is it whether the AFC or the NFC wins the Super Bowl? Is it what else could it be? Could it be what an NVIDIA does, what Bitcoin does? Is it all the AI in the world is going to make labor non-existent and everybody's going to have a subsistence level income from the government paid by billionaires who don't want to pay you to work because they're just going to use the machines? And they're going to have all the money in the world forever now? What is it? What causes a stock market correction? What goes down, right? Oh, yeah. Liquidity. More money equals higher asset prices. Less money equals lower asset prices. They covered this in Econ 101. Okay. 101. Econ 101, supply and demand. So Teresa on her charts uses supply and demand zones. It's a method of measuring liquidity. And what we know is that when global liquidity, the M2 money supply, falls, and more importantly, when the rate of change is negative year over year, we tend to get a stock market correction lag by anywhere from 3 to 9 months. Sometimes a year. Sometimes it happens like as soon as people, read the paper, which seems to be people only read on the weekends now, it seems like. I really do think it's funny that these narratives hit on Fridays and Saturdays. It's like, oh, maybe we should read something. So all week long, people are trading, click, 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 just like spinning the roulette wheel, just like rolling the bones. I mean, I will tell you that the level of gambling in the stock market today is far higher, not even close, far higher than 1999 or 2006 and 7. It's not even close. Now, what's different is that a lot of the S&P 500 companies are profitable today versus 1999 they weren't. And in 2007, some were, some weren't. Corporate balance sheets across maybe 60% of the S&P 500 are somewhere between good and great. You only have about 200 companies that are dog shit, which is below average. Russell 2000 is right where it normally is. About half the companies profitable or close to profitability, about half not. But it's such a big index, 2,000 stocks, that why would you invest in the index when you can just pick out the profitable companies and the companies exhibiting positive momentum? But even that stuff flies out the window when overall liquidity to the system is decreasing. There's just going to be lack of firepower, lack of free cash to buy stuff. And we had a huge uptick in liquidity we had a huge uptick in liquidity going into COVID. And you'll notice that it started before COVID. What was happening in 2019, second half of the year? 2 syllables, rhymes with go. Do 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 do. The fucking repo market. Oh, sorry. The Zucking repo market fell apart. August, September, October. And we got stealth QE before COVID. They had it was called a special facility. Don't call it QE. It's a special facility. How often do I have to say this? Come on, man. You're killing me, Smalls. And then we got into COVID and they did QE infinity, and global money supply went through the roof and caused a major jump in the stock market. And now we have stock market way up here. Liquidity came off and then kind of been jitterbugging down lately. So the question becomes, does liquidity keep falling or does it jump up? And I would say it probably falls for a while and then by next year is jumping up. Why by next year? Who gets a job next year? Who gets a job next year? That's right, the Fed chair. You guys really rely on Teresa to know the answers. Somebody else can raise their hand, but don't raise your hand. Just, type in the answer. Chairman Powell is currently doing quantitative tightening. He's going to pause interest rate cuts. I have said that I think that is a policy error. We are already starting to see, and it was discussed on Bloomberg this morning, that construction starts are starting to slow down again. The new housing starts are starting to slow down again. That's a leading indicator of what employment's going to do next. So while Trumpty Dumpty was throwing people on airplanes, military airplanes, because they have nothing better to do, and deporting people to seek asylum from other locations because it really matters. Really, the cost of those flights, the rounding up people and the cost of those flights is more, just so you're aware, is more than just letting them hang out here. Did you know that? We're spending more money to deport people than it would cost us to keep them here. Think that through. Using military transport planes and the threat of tariffs, this time against Colombia, and I'm sure it's coming with other countries, to deport people that we need for the labor force because 4 million baby boomers are retiring every year. We have fallen liquidity because most nations on earth and most corporations and most super wealthy people don't really have any faith in Donald Trump. So while he can yell America first all he wants, I'm being very frank here, I don't care if I offend anybody's sensibilities, the confidence in President Trump is extremely low. And that means that you're probably going to see some disruptions in the global economy. Now, does it all work out in the end? Yeah, sure. How does it look between now and then? Look, the American public, if they have money in their pocket, are going to spend it and invest it. But if global liquidity is falling and unemployment rises, what happens? This isn't rocket science. This is the most basic quantitative analysis you can do. Employment is what we should be most concerned about. If the unemployment rate goes up, yes, somebody typed in, people stop putting money in their 401ks, and in fact, they're pretty quick to cash them in. I know a guy who switched jobs. He's in his 50s. He's got $70,000 in a 401k. In his 50s, that's what he's got. And he's going to cash it in. I'm going to pay some bills and buy a car. This guy's going to be in his middle 50s, and I believe he'll be debt-free other than a house payment, but with zero in his retirement plan. We know that defines about 60% of baby boomers who are retiring. They're trying to retire with a paid-for house. Not all of them succeed. A Social Security check, and they think $30, $40, $50, $60, $70,000 is like matters. I put something on Twitter the other day, Twitter Twitter X. The national debt is $34 trillion. The combined wealth of the richest 1% of people in America is $45 trillion, approaching half of all the wealth in America. The tax cuts to the richest 1% since George W. Bush, because we can measure that. It's actually been since Ronald Reagan, but since George W. Bush, the tax cuts to the richest 1% are a little over $20 trillion. Looks like 23 trillion. It might be as low as 17 or 18, but 23 trillion, around $20 trillion. So half of the richest 1%'s wealth is tied to the tax cuts since George W. Bush, and that is directly proportional to the debt that has gone up. At some point, this stuff has to start clicking in people's heads. How bad does it have to get for that to click? I don't know. And how long does it take? I don't know. I think it all comes to a head in the next 5 years as the last baby boomers get on Medicare and Social Security. So ask yourself the question, if liquidity is tied to asset price returns, and in the short run, we're getting a liquidity hit before probably a new Fed chairman does quantitative easing next year, And we're running into a period of private credit being peddled to non-sophisticated investors and hedge funds being peddled to non-sophisticated investors, people who were bad at investing to begin with, and now they're just buying more expensive and more complex products because that always works out for them. And most of the U.S. government debt that's issued this year will be coming due in 5 years because they don't want to write 2-year treasuries again, because then they'd have to deal with this again. So in the next 1 to 2 years, you're going to see a liquidity crunch as we refinance over $6 trillion of debt. It is the first time in my lifetime that I will actually see an example of crowding out, something I learned about way back in 1988 and 89 when I took Econ 101 and 102 and 301 and 302. Crowding out is when the government soaks up so much money during a period of what's called fiscal dominance, FISCAL, that capital can't go into the system. Now, sounds like we're going to find $1 trillion or $2 trillion of investment from other countries, from sovereign wealth funds. Oh, yay, yay, yay! Except that they own the stuff. Huh? What does that mean? What does that mean when foreign money comes in here and buys things so that we can continue to overspend? It means that at some point we don't own the stuff. So out of one side of his mouth, he's saying, hey, we don't want Japan, or we don't want Nippon Steel to buy U.S. steel. At the other side of his mouth, he's saying, hey, look at SoftBank in Saudi Arabia investing $1 trillion in the United States. I don't think it's quite that much, but it's around there. So we'll let them buy all these things that you've never heard of, and land and buildings, and be in charge of our workforce at those places. But we're protecting you from Japan buying U.S. steel. Do you get it? Do you get the bait and switch? Do you get the misdirection? So what do you do about it as an investor? Well, what does this look like to you? What is that? What have we been calling that for years and years? Whenever we see a chart that looks like that, come on, somebody think about Florida. That's right. Alligator jaws. And what happens after you see alligator jaws? Remember Barney? Alligator stew, alligator stew. When this thing bites down on me, I don't know what I'll do. Right? Me and Weird Al hang out. So this is gonna jitterbug. This has to come down, and then this will go back up, and then this will go back up. Sequence of events. Can you index? Sure, but at these valuations, and given the fact that since 2009, here's a statistic, we have seen an average of 40 to 50% higher stock market returns than the rest of history. Huge increases in liquidity, right, after a fall off. So the absolute level of money is much higher than those growth rates. And we can see that it's really the United States that's done the best. And interestingly, I believe that's Brazil. Oh, Japan. Japan's done well. Japan and the United States. There we go. And Brazil. Hong Kong's down there. So the United States has done really well. How well? Second highest valuation in history are equities divided by money supply. And if money supply is coming down, or even just going sideways, because ultimately it's the growth rate of money supply that's important, right? Look at these huge growth rates of money supply. Little itty bitty periods where it comes down. And this caused the recession-ish and correction behavior in 2022. So if this keeps coming down, if the growth rate of money supply keeps coming down, which it certainly appears that it will, and it is, at least this year, or part of this year, you'll get those alligator jaws to close a bit. Now, here's the thing. I don't think anybody in government or central banks has the stomach for an outright depression. I don't even know if they have the stomach for a real recession. And ultimately, there's plenty of the world to rebuild, or just build. So that's what we have to embrace. That part of Donald Trump's agenda is, in my opinion, correct. I don't know why he's giving the richest people tax breaks again. And if you've noticed the proposal from Mike Johnson, if you're middle class, it's not so good for you. Even the SALT deductions are meant for higher income people. Taking away food stamps, they're probably going to screw up healthcare. And I hope not. I'll throw something else out there for you. People like me, you're mini millionaires. I have 10 years to go to Medicare. I've been buying my health insurance on the exchange. People like me are probably 1% of the population, but we're part of that second and third percentile for wealth. And I'm just going to tell you that my subset of people, your 7-figure something, maybe low 8-figure group, Why on earth would I stay in the United States for retirement if they take away Social Security and Medicare? Why would I spend my money here? Why would I pay taxes here? Just throwing it out there. The impact of the actual policies are probably not particularly good for most people unless you are capturing huge tax breaks. And while I'm working, I can, so I will. But when I retire, or probably semi-retire at 65, and then I'll probably work forever. But why on earth would I keep the majority of my wealth here and my spending here if they're going to screw me out of all the things that I've been paying taxes on? Because my tax rate is higher than Elon Musk's and Warren Buffett's, which doesn't make any damn sense. These things impact the market on long and variable time legs. And for you and me, as far as trading this goes, remember, I'm a position trader, not a swing trader. I don't really care about the next 3, 6, 4, 8, 12 weeks. Not too much. To me, it's more about quarters and 6-month periods on the short side, and then the next few years on the long side. And I don't know if I'm going to be right about my base case. My base case is that we get a 2018 or 2022 type year this year, followed by a big rally until it all breaks. We'll see. So what am I doing in the short term? I bought some March $550 puts on SPY, bought puts. I don't do that often. Long put. I'm about even on that trade after a week. For people who followed me in the next day and the day after that, you got a much better deal. You're probably profitable. I know somebody said that on the chat board this morning. I would expect a rebound rally sometime this week. We get one of those big dumb up days and everybody will go, oh, look. It was just a bad day. Folks, it's a harbinger. So I'm going to add more puts on the rebound rally when all the narrators start going, hey, it's back. Probably spend 10 or 15 minutes a day on X. I put this in the chat too. Stock market looks for a narrative to justify its moves that were coming anyway. So I warned you about a sell-off. We have one down day that's more than 1%, close to 2%, and people flip out. Valuations plus liquidity. That is what sets you up for a correction. Here, this guy. I don't understand this morning's sell-off. Derp. This guy's a big poser. I've been reading him for years. I unfollowed him today. Just a wealth of bad information. He just regurgitates stuff. I have to admit, I don't understand this morning's sell-off. The DeepSeek development was already public knowledge last week, which is what I told you. What incremental information did we get over the weekend? Sips coffee, shrugs shoulders, rolls eyes, makes smug face. High valuations and falling liquidity plus a random narrative multiplied by a random narrative equals a sell-off. How bad does this get? I don't know. President Trump in 1 week is already running around threatening everybody that we trade with. Europe, Central and South America, Canada, Mexico. You really think that works out well for us? Breaking down the international order that is directly responsible for your wealth and your standard of living. Because we have benefited from the strong dollar. Yes, there is perpetual counter-cyclical policy that is inflationary, but the natural forces in the economy, which are technology and demographics in particular, and climate change in an indirect way, are disinflationary and deflationary. Milton Friedman's students, by the way, figured out he was wrong, just like Laffer's students figured out he was wrong. And yet these people, because they say something that 0.5% of the people want put out there, right? They get carried along and made rich because they'll just run their mouths. I'm telling you this as a guy who worked for Rupert Murdoch Company, was recruited by Koch, and was recruited by Breitbart. You can believe me or not believe me. I believe that if they follow through with the plans that they've been pushing through for a week now, the executive orders and Mike Johnson's initial proposal for a reconciliation bill, and the way they're handling trade, and the likelihood that there's one more thumping coming in the Middle East, the way that they're feeding the energy, the oil and gas crowd by putting a thumb on clean energy and alternative energy at a time when we need more energy, and there just isn't enough oil and gas to keep up. There are a lot of things they can break. Do I hope that it all works out? Sure, I hope that it all works out. Hope is a horrible strategy. Follow the money. Over and over and over and over and over, I tell you, follow the money. That approach has never, ever failed me. Ever. Do things not work out as well as you think sometimes on a trade? For sure. But where the big money is going, whether it's government money or rich people's money or corporate money, that combination, those three things, sovereign wealth funds, I consider government, that big money controls almost everything. 1% of the people have half the wealth. Now, if you take a look at it from the standpoint of what corporations have and sovereign wealth funds and everything else, that number is closer to 90%. That means that about 99% of the population has about 10% of the wealth globally, and 10% of that 10% has most of that. So 2 or 3% of the people on the planet own almost everything, directly or indirectly through corporations and various entities. A loose affiliation of millionaires, billionaires, and babies. Who said that? Anybody know the line? The Boy in the Bubble? Paul Simon? There are a lot of things that some of the artists, Paul Simon, George Carlin, get right. Sometimes they're just out there trying to make a buck. A lot of comedians and artists, right? They just want to make a buck. Just like the people who take the jobs that I've turned down. And all I can do, and social media and the internet and writing platforms have helped me do it a little bit, right? I'm certainly not a big internet star. I have about the most minimal level of internet fame you can have, but I try so that you can tell your kids and your grandkids and your nephews and nieces, cousins, anyone else who's open-minded, that what we're probably doing right now is probably mostly wrong from the standpoint that there were a lot of things that needed to be fixed because they had minor problems, but they didn't need to be thrown out or broken all the way. It's like having a little tear on the side of a leather couch and saying, I'm going to use one of those patch things. You'll barely be able to see it. Versus throwing out the couch and buying some synthetic, crappy material instead. All the people who chant globalism is bad are probably doing pretty well because of it. And the major problem truly, and I promise you this as somebody who's getting richer and richer, that the system is completely and utterly set up for people with money to make more money. It's just the way it is. And that probably never can completely change and probably shouldn't. However, there is a big skim going on, and I've been trying to warn you about it for a few years, for about 5 years, 6 years, since 2017, really, that I thought maybe we had gotten over after the financial crisis. Thought maybe we were going to slowly fix it. And maybe there's a snapback to fix it in 2 years or 4 years. I don't know. But from what I can see right now, it's getting worse. If you break global supply chains and in turn break alliances for security, you invite vacuums of power that end up being really bad news. It's one thing to demand a little bit more from your allies. It's another thing to basically make them feel like they're not your allies. It is a tightrope. I don't see this current administration shaping up to be a bunch of ballerinas. They are Godzilla on a bad day, just stepping on things. And so when I tell you that I am always optimistic long term, because we figured it out in the end after trying everything else, Winston Churchill, for those of you who forgot, it is what it is. You have to trade your way through it. You have to respect what's going on. You have to understand the fundamentals. Once again, I come back and tell you, overvaluation and falling liquidity equals falling asset prices. It can happen in different shapes. Time delays can be long and variable. It's hard to know exactly when things will happen. But for the most part, somebody mentioned this today, that I've had a whole bunch of trades that have worked out pretty well lately over the last couple of years. Really we were late to get in after COVID, except for that initial round of investments, but called the top 2021. And I think I've roughly called the top this time. This is the last warning I'm going to give you about getting to the defensive end of your asset allocation range. And if you insist on telling me I'm going to 100% cash, I'm just going to tell you that you're not paying attention again. Read the materials. Define who you are. Understand it. Be honest with yourself. My investing is hyper aggressive. For clients, I'm pretty middle of the road. I have to be. For most of you, you should be between 40 and 80% equities all the time. After a steep correction, you can get up to 99, 98% equities, but then gradually work your way back to 80% over a number of years. So somewhere between 40 and 60% cash and short-term bonds is where most of you should be yesterday. You still want to hold on to your small and mid caps that are less dependent on the overall market and have their own set of catalysts, their own set of drivers that can happen in the next year or two. Doesn't mean you need to buy any more of them right now, but selling some of these small and mid cap stocks that we know that we can wake up and they're up 40 or 50% and they double in a month once in a while. Don't screw around with those. If you own things that are correlated to the S&P 500, you should be getting rid of most of them. Get down to the things that are less correlated to the S&P 500, which are your small and mid caps. As far as DeepSeek is concerned, it is a lightweight AI that has some merits. But if you think the Chinese told you the truth about what it is, what it costs, I just want to laugh at you. Why would you believe the Chinese? Seriously. And it also means that if they did anything that's truly revolutionary or efficient, won't everybody else already copy it? I've told you with Perplexity, I have like 6 different AIs I can choose from super comprehensive to lightweight. Stuff's already out there. What's really coming is large quantitative models versus large language models. Large language models are mostly trained, and now we're just kind of organizing them. It's the large quantitative models, the ones that can think with the help of incremental steps towards quantum computing, that are going to be pretty neat. Sandbox AQ, I tell you about it all the time. And in the short term, natural gas is a great investment because most of the natural gas in Texas comes from affiliated drilling, meaning they get it from oil. They drill for oil, they get gas. And we know that even if we don't have a whole bunch of new EVs in the next 4 years, every single car on the market that's been designed in the last decade and is coming on to production now is far more efficient, right? 20, 30, 40, 50% better mileage. And in most of the world, they buy that stuff. Yeah, we all like our Suburbans, our big SUVs, even me. I bought a Santa Fe, or I leased it, gasoline. Didn't even bother with the hybrid. Why? Because it's 3 years. And I drive maybe 1,000 miles a month, maybe in a big month. I just want something I could write off better than call an Uber. Something I could throw the kids in the back of. So at a minimum, get to the conservative edge of your asset allocation. If you are a thrill seeker and understand this trade, I would start buying puts, just a little teeny tiny bit. Starter positions. And start some in March, some in April, some in May, some in June. Just slowly add a month every month. So I already did the March trade. My next trade, I'm probably going to do April 30th. Then I'll probably do June 20th or 30th. Just every few weeks, add a little bit more. And if the market starts to really get tanky, pyramid these up. Add on to your winning positions if the downward momentum really takes hold. And if you do that, and you understand that you have to look at these things morning, noon, and near the end of the market, right? You can't just buy these and then, oh, he's going to send me an email when it's time to close it. No, that's not how it works. If you think that's how it works, don't do it. But if you're aggressive like me, you're buying some puts and you're managing them pretty much week to week, but you watch them every day. Would I close my March puts right now? I'm not, because I'm barely even. But if you got in a couple days after me and you've doubled or tripled your money already, yeah, take a little bit off with the idea that you're going to put it on again for April, that you're rolling the position out to April. You take the profit of the day, wait for an update in the market, then buy the April puts. The only puts that I would be selling are the natural gas related puts, and not all of them have premium. So if you take a look at Permian Resources, you want to sell the $15 put for April. Yeah, low volume. You might not get much for this. 87 cents. Better than a sharp stick in the eye. Katera, April 28 or 27 maybe. 80 cents. Again, better than a sharp stick in the eye. New Fortress Energy is probably the one that I would do myself. So it's down $1 today. We sold the April 14th, so you get $1.50, $1.82 maybe. And that's over 10%. They actually had good news just the other day. But for the most part, I would be looking at just continue to move to the conservative edge of your asset allocation. I don't think we're there yet on TLT. Still just cash. If it gets down here, though, gets down to below 80, I'm probably going to buy it. Because in a falling liquidity market, the odds of getting inflation in the short term are almost zero. So all these people thumping their chests about inflation still, they just give me a headache. Technology is disinflationary. Demographics are deflationary. People argue with me about that. I'm just like, you have no idea what you're talking about. It's really easy to read what's out there. Aging demographics are deflationary. Stop. Aging demographics are deflationary. There is no empirical argument against that. Zero. No, well, a lot of the baby boomers spend money on vacations. Yeah, sure they do. They don't spend money on bigger houses and kids and a third car. When you get older, you don't do that. Household formation is what causes spending. It's another reason we need all the immigrants. So I'm not ready to buy TLT. I think that trade is coming soon, in which case I'll own it for a year, maybe two, and then I'll scale out of it to buy equities. I don't know if we get a stock market crash this year, but take a look at 2018 and take a look at 2022. That's what it looks like to me. There is a 1999 argument, but I think that's unlikely for two reasons. One, a lot of the companies are profitable. And two, by next year, the Fed is unleashing more liquidity. Maybe by this year. Just keep an eye on it. Now, if Chairman Powell surprises me and cuts at the next meeting, then we'll see. Maybe they're going to spike this thing up before it crashes. We shall see. We want to see if he lowers interest rates, and we want to hear what they say about quantitative tightening because they've gone radio silent on that. They have not changed that, and everybody was expecting them to be done with quantitative tightening by spring, and now it's looking like fall or next year. Very hard to gauge the dynamic between President Trump and Chairman Powell. Very hard. And what is the best forward indicator of problems in the stock market? One word, compound word. What is the number one thing to watch? If this rises, stocks will eventually fall. Unemployment, exactly. If unemployment rises more than about a half a point, maybe we got problems. So there you go. Not a lot to do right now. Keep inching your way towards 40 to 60% in equities, depending on you. But I think the inching is almost over. I think you need to hustle. Sell into updays. If you have SPY or any ETF that's highly correlated to SPY, dump it. First place you dump. And then go through those large cap stocks. You go, but I like the dividend. And figure out if it's in an IRA, it's easy to sell. If it's in a taxable account, you got more math to do. Anything that you think can drop 20% or more probably is a sell. Anything that you think won't lose 20%, or if it does, it'll be short term, you could probably hold on to it in a taxable account if you don't want to generate taxes. Reason I use 20% is because that's the capital gains tax. If you're in a high tax state like California or Connecticut, you got to put a little bit more there. So maybe you change it to, I'm not selling something unless I think it can drop 25%. Easy way, easy shortcut for that. Somebody give me a large cap stock that's done well. Let's look at Lilly. All right, Eli Lilly. Can Eli Lilly drop 25%? There's one correct answer, and it doesn't have an O in the word. Right there. Very easy for Eli Lilly to drop 25%. How do I know? Oh, look, an Eli Lilly clone. Huh. I don't whistle good, but right? I don't think this is likely. I'm not even gonna have that on there. This can happen right in here for sure. So why can't Eli Lilly do that? These are the sorts of things you got to look for. Let's do 5 years, right? Okay. So if you own Procter & Gamble, the first thing I'm going to say to you is why, right? Why would anybody own Procter & Gamble? Honest to God. Absolutely, the stock can get crushed. There's no growth. This only happened because there was a restructure, right? An activist investor that restructured a company. And we talked about it way back here. Get out of Procter & Gamble. Super easy for it to go down to close to 100, especially 113. If you have a step up in basis on this one, Teresa, sell it. Oh, okay, good. Right? There's all kinds of stocks like this in the S&P 500. Take a look at what they did before 2019, before COVID. Understand QE infinity, and now liquidity is tightening up again. Stock after stock after stock after stock. There's nothing to look at with Ford. It's been beaten down already. Totally to sell it up at 11 and 12. Okay. It can get down into here. Super easy for it to get down there, but it's so close, right? So think about this more in terms of what is it to your asset allocation? Is it a big part of your asset allocation? Yeah, then trim it back. Is it a small little bitty starter position? I don't own any Ford right now. If it's a starter position, you're fine. And then just know that if it gets from here, from there, where's my little range thing? There you go. That is where it can go. Pretty simple. The odds of it getting down there are pretty low. Right about there, right there. That's where I'd be buying Ford. Teresa, does that look close to what you would do? Is that what yours kind of looks like? Yeah. Marvel. I don't even know what their symbol is. Is it MVL? Hold on, let me see. Let me save the Ford one. We'll take a look at the bottom. Marvel. Oh, this is something else. MVL. Yeah. Oh, where's my? There we go. Yeah. So for sure, down to look at this orange line, green line, right about here. Easy. Then this is basically automating what I did a second ago, right? If you have trading view, just use the VRVP to see where the big zones are. I'd say go back 2018. Yeah, I don't think you need what's behind there. You make your chart look like this. Make it a decade, 2027 to 2018, right? I don't know what I just did there. Put in your institutional fair value gap. Make sure you have the volume weighted, your Wyckoff Springs. Lux Alco sometimes helps. This kind of does what Wyckoff Springs does, but in shorter term time frames, right? They do the same sort of thing. It's just the Lux Algo has more signals. I mean, pretty easy, right? You put in your linear regression channel. When you're up at the top of it, if it's not breaking out, then it probably is going to come back in. Probably going to test down here at some point. And then maybe it breaks down all the way to here. I encourage you to read those books. I've asked you to read Getting Started in Technical Analysis for the last 3 years, 4 years. Take a look at the book list. Read the high school level stuff at a minimum, right? Now, I'm still a seller in the strength because there's a lot of money out there and a lot of hyper traders. Keep this in mind. And I brought it up 3 years ago or 4 years ago. No, I can't remember. The millennials are fairly sophisticated traders at this point. Doesn't mean they're wise, but it means they know how to use the tools in a toolbox at the tool level. They might not know how to build anything, right? It's like saying, I know how to use a drill and a screwdriver and a hammer and a saw. That's good. But can you build a house, right? So the millennials, because they're fairly assertive short-term traders and they understand how to use tools, if this market starts to fall, they're going to pile on. They'll start shorting. Hear this. If the millennials start to short, they are doing it with the express purpose of trying to outtrade the boomers who have not been good traders. And all they really want to do is scare the hell out of you, take your money, rather than wait for their inheritance. That's why they change jobs and just keep going to where the money is. And that's why they try to outtrade people in the market, because in the back of their heads, they're taking somebody else's parents' money. Because it is the boomers who panic sell over and over and over again. And if people lose their jobs, it doesn't matter if they say that they're a long-term index investor. They lose their jobs, A, they're not putting in, and B, a good hunk of them will take out. Rinse, repeat. I say this without any notes because I've seen it before. If you have stocks with charts like this, you need to trim or outright sell. And you need to be honest with yourself about what your risk tolerance is. I have a client, gave me some extra money this week, last week, coming this week. He said, manage this with the express purpose that you cannot take a 30% drawdown, which is actually easier said than done. Actually easier to do than people who say it's easier said than done. It actually isn't that hard to do. You just move your asset allocation down to the low end of the equity range. For me, that's about 40%. Anybody who would go below 40% in equities, you're trying to be perfect. And what do we know about trying to be perfect? You just have to be lucky for that to happen, right? All right, I'm going to go back with the grandkids, and I think we're going to go see the new baby. At a minimum, we're going to the museum first, then maybe the new baby. We'll find out. Got to talk to mom. All right, take care.